Bonjour everyone, Jamapel Shirley, and I will be walking you through the GFO slides for July 2025. Before we begin this presentation, we want to note that this is only for informational purposes only and does not constitute any investment advice. Now let's dive right back in. Let's look at what's shaping the markets as we head into the second half of 2025. The greenback has hit 3-year lows, and even the recent geopolitical flare-up in the Middle East couldn't provide sustainable support. We saw the US dollar index fall to levels not seen since February 2022, down more than 10% year to date. To put this in perspective, we're experiencing the second worst start to a year for the dollar since 1967. What's particularly interesting is how other markets have shrugged off these concerns. The S&P 500 and Nasdaq both hit all-time highs, suggesting that the combination of a weaker dollar and hopes for eventual Fed rate cuts is proving to be the perfect tonic for global markets. In Europe, the euro has been one of the best performers, with euro-US dollar hitting its highest level since mid-2021. This strength comes as markets price in that the ECB is near the end of its rate-cutting cycle. Meanwhile, sterling has been more sensitive to geopolitical worries, falling to two-month lows versus the euro, as the Bank of England signals greater willingness to consider mid-year rate cuts. Down under, the Aussie remains under pressure from global trade policy concerns. It's steady against the US dollar, but weaker versus most other currencies. Now, this really highlights how trade uncertainty continues to weigh on commodity currencies. Let me walk you through 3 critical themes that are dominating market narratives right now. First, the Fed easing debate continues to evolve. Chair Powell has maintained his cautious, data-dependent stance, but we're seeing increasingly dovish signals from other Fed governors. Bowman, Waller, and Goolsbee have all noted that tariffs haven't driven inflation as much as feared. The big question is whether these growing internal divisions and political pressure will prompt earlier easing than markets expect, or if we'll need to wait for a potentially more dovish Fed appointee under Trump in 2026. Second, stagflation fears are making a comeback. We're seeing a toxic mix of global trade worries and structural headwinds. The uncertainty around US trade policy and escalating geopolitical tensions are stifling growth while fueling inflation through higher oil prices. In Europe, subdued demand and internal fragmentation continue to weigh heavily. Growth projections for 2025 are just 0.8%. The ECB has limited room to maneuver, while the Fed's stance suggests tariff-driven inflation may delay rate cuts. Third, the dollar is losing its geopolitical shield. Historically, geopolitical flare-ups have provided support for the greenback, but even that's fading now. The US brokered ceasefire between Iran and Israel announced at the end of June has seen the dollar resume its negative trajectory. With renewed uncertainty around Trump's policy direction and a widening fiscal deficit under his big, beautiful agenda, structural pressures are reasserting themselves on the dollar. Now let's focus on what could be the most important date for July, which is July 9th. President Trump has dubbed it Liberation Day, setting it as the deadline for the US to conclude bilateral trade agreements with key partners or face significantly higher tariffs. Now here's what's at stake. Baseline tariffs will jump well above the current 10% level for countries without a finalized deal. So far, only the UK has secured a formal agreement, though it retained the 10% reciprocal tariff and left contentious issues like the 25% steel duties unresolved. Negotiations with other partners are ongoing. but struggling to reach consensus as the deadline approaches. China remains in a holding pattern under a fragile truce extended into mid-August. Washington has hinted that countries making productive progress may receive deadline extensions, but the uncertainty has already rippled through global supply chains. Many companies, as you have known, may have spent the past quarter either front-loading imports or simply bracing for impact, unsure whether these proposed tariffs are a bargaining tool or an imminent reality. Legal challenges to the administration's authority to implement these tariffs add another layer of risk as we head into the second half of the year. Now, this slide shows the key market events to watch for July 2025. And now let's switch gears to the FX. Looking at the pound, the sterling is currently trading around 1.37. UK macro data has deteriorated somewhat with easing inflationary pressures acknowledged by the BOE at their June meeting. Now, this may be supportive of 3 more 25 bips cuts by year end. The tariff headwinds are already impacting UK data, will likely feed into other G10 economies eventually. And the silver lining is that UK consumer headwinds continue to ease. And with UK services being a more pervasive driver for the economy, we do think that UK will escape the worst excesses of global protectionism. Now, looking at the chart here, we do see pound trading in a range with our base case scenario, showing it around 1.35 by year end of 2025. Now, moving on to the next currency, in Euro US dollar, it has performed well recently, currently around 1.17, and our base case seeing it reaching by 1.14 by year end. The game changer has been NATO's agreement to increase defense spending targets to 5% of GDP by 2035, with at least 3.5% dedicated to pure defense spending. And this represents more than a doubling from the previous 2% target and implies trillions of dollars in defense spending, with Europe expected to contribute significantly. Germany's draft budget already indicates a large increase in defense and investment spending. This massive fiscal commitment addresses what markets have underappreciated: Europe's defense needs creating a structural beat for the euro. The required 8% annual growth in NATO defense spending through 2035 represents a multi-year tailwind for European growth. And this fiscal expansion stands in stark contrast to concerns elsewhere and provides Europe with a legitimate growth catalyst that doesn't rely on monetary policy. We continue to see tariffs as an opportunity for Europe to reform itself and push for trade deals elsewhere. Now, the combination of defense-driven fiscal expansion, improving growth dynamics, and the dollar's structural weakness is Euro-US dollar supportive. Looking at the Aussie dollar, currently around 0.65, our base case, as shown on the chart, sees it reaching 0.64 by year end. Australian dollar lagged in the first half because policy-induced uncertainty emerged as a major headwind for global growth, and US-China trade frictions escalated beyond expectations. However, a series of constructive developments appear to have solidified the detente between US and China. On the domestic front, Australian dollar has proved resilient, and intensifying fiscal tailwinds suggest market pricing for front-loaded RBA cuts is unlikely to materialize. If geopolitical risks does come up again and oil price rise, Australian dollar may outperform on crosses, as we could see a positive Australian terms of trade shock if recent price increases are sustained. Now, moving on to US dollar yen, the depreciation pressure on renminbi has eased since the US-China tariff truce on May 12th. Looking at the chart, our central base case scenario is around 7.31 by year end. Encouragingly, the spot US dollar CNY exchange rate has moved closer to the daily fixings set by the PBOC, and the spread between US dollar CNH and US dollar CNY has narrowed notably. The so-called convergence of the three FX levels has been restored, providing a comfort zone for the PBOC. At the recent Lu Jiajui Forum, the Deputy Governor stated that additional QDII quotas will be granted soon, showing regulators are comfortable with the current exchange rate and shifting focus towards further opening up the financial market. And finally, moving on to the US dollar CAD, it faces a two-sided near-term risk, currently trading around 1.36 to 1.37. Q2 GDP could surprise to the upside versus consensus forecast, and the TSX may continue to outperform global equity markets. However, the Bank of Canada could still cut rates maybe 3 times in 2025 once core inflation comes down. Unlike most US dollar G10 pairs, USD CAD still has positive correlation with the 2-year US-Canada rate differential. Looking at the chart, we can see that the US dollar CAD to remain elevated, showing around 1.4 handle by year end of 2025. And that'll be all from us this month. Feel free to reach out if you have any questions. Have a good month. Bye.